Monthly fixed pay ETFs and funds are a brain fart. Similar to dividend investing, it's a brain fart. I talk with people often that have an ETF or mutual fund that pays a fixed monthly amount. In most cases, they misunderstand it. Most think they're getting regular income, but it's usually a brain fart. Examples recently have been covered call ETFs or dividend ETF funds, but there have also been monthly income funds, mortgage funds, T8 or T6 mutual funds, been around a long time, REITs, and others. So what we're going to learn today is why are monthly pay ETFs and funds a brain fart? How do fixed monthly pay ETFs or funds work? Why is a monthly distribution not part of your rate of return? What is the difference between a distribution and a dividend? Why is a monthly distribution not new money? Why does a monthly distribution equal selling shares? Why does a reinvested distribution equal no distribution? Why do covered call funds usually have lower returns but higher tax? Why are monthly pay ETFs or mutual funds a problem for retirement income? Why are monthly pay ETFs and funds a problem for leverage investors? How can we get out of the brain fart? How can you perfect monthly pay funds? What are self-made dividends, and why are self-made dividends a perfect fit for your life? Okay, so talk today is monthly pay ETFs and funds are a brain fart. So why are monthly pay ETFs and funds a brain fart? So in short, the fixed monthly amounts that you get, they are probably not all income. They are not part of your rate of return. They are not a dividend. They are not new money, and they're simply withdrawing cash from your investment. So that's really why I'll explain more as we go along. So how do fixed monthly ETFs or funds work? So to understand this, you have to understand the difference between income and cash flow. So income is what you pay tax on. Cash flow is the cash you received. So now fixed monthly pay ETFs or funds are usually, but not always, invested in something that pays income. But the income you get is rarely the amount that you receive in cash, exactly. So you receive the same cash every month, regardless of how much of it's taxable. So the income shows up on your year-end tax slips and statements. It is the same regardless of how much cash you received. And the distribution is the cash you received regardless of how much of it is taxable. So now if the cash distribution is more than the income, the difference is return of capital, which reduces the book value of your investment. This means you have a larger capital gain in the future when you sell. So that's basically how they work. So why is a monthly distribution not part of your rate of return? So a monthly distribution excludes the increase or decrease in the value of your investment. And it probably also includes some return of capital, which is not growth or income. It's some of your invested capital return. So there's a big reason and a smaller reason why your monthly distribution is not your rate of return. So now your rate of return is shown on year-end tax slips such as T3, T5, or T5008, plus it's the growth, or gain or loss on the value of your account. For example, you get $100 a year of interest, $300 of dividends, $100 of option premium, $1,500 of capital gains that you realize from selling something. So that's the income of $2,000. And let's say the value of your investment has also gained by $8,000. So you've made a total of $10,000. So now if that's a $100,000 investment, that would be a 10% rate of return. When we listed all of this, none of this is the distribution. The amount of the distribution is irrelevant to your rate of return. So now here's an example with a loss that's more dramatic and makes the point. So let's say that investment, $100,000, you receive a distribution of $10,000 paid monthly throughout the year. Out of that distribution, $2,000 is taxable. But meanwhile, the investments themselves, it's a bad year, they're down $30,000. So what happens? Your $100,000 investment is now worth $60,000. So it lost $30,000, and you received $10,000 of cash from it. So the $10,000 cash is $2,000 of income and $8,000 return of invested capital. So you pay tax on the $2,000, even though your investment's down $40,000. So now note your rate of return is a large loss, even though you received this monthly distribution. So that just makes the point. Now, what's the difference between a distribution and a dividend? So a distribution is the payment of income. It's not income on its own. So a distribution can include various types of income or capital gains or return of capital. So meanwhile, a dividend is one specific type of income paid from stocks. So now, why is a monthly distribution not new money? A monthly distribution is not income. It's cash you received. It might include income and it might not. If you did not receive the distribution, you still would get the same tax slips and put the same income on your tax return. The only difference would be the cash you received. So, and the cash you received is money you invested. It's not profit. Okay, it's part of the money that you get back, part of the money that you originally invested. It's not a profit. It's just a payout of income, or it's a return of capital, but it's a part of the capital that you received. Now, why does a monthly distribution equal selling shares? Well, a fixed monthly distribution is paid to you whether or not there is income. So, and the taxable income is on year-end tax slips whether or not you received a distribution. So they're not required for each other. If there was no distribution, but instead you sold the same amount of your investment, you would have the same income, the same cash flow, except you get probably a small capital gain or loss on the small amount that you took out. So, but otherwise, you'd be in the same position by having no distribution and then just selling a bit of the fund. Now, why does a reinvested distribution equals no distribution? So if no distribution is paid, you still get the same tax slips for taxable income. A distribution is a payment. So receiving a distribution payment and then reinvesting it is, it's essentially the same as not receiving at all. So your investment gives you cash and you give it back. If your investment just kept the cash, that'd be the same thing. Okay, now why do covered call funds usually have lower returns but higher tax? So covered call ETFs or funds can be a fixed monthly, they can have a fixed monthly cash flow. This is a relatively new thing that's been very popular kind of recently, but again, they're kind of a brain fart. So they involve owning stocks and then selling off an option to buy the stock from you, usually somewhat higher than today's price. For example, you have a stock at $100 a share, you sell for $1, a call option for another investor to buy the stock from you at 110, usually within 90 days. So if the stock stays below 110, you keep the stock and you get the $1 premium. That sounds good, right? Now, if the stock goes above 110, the other investor buys the stock from you at 110. Okay. Now, if the stock goes bankrupt, you lose all your investment, except for the $1 premium. So that's kind of how it works. Now, in short, you get a $1 premium, but you lose the growth of your stock above 110. Your gain is capped, but not your loss. So now most investors underestimate how often stocks rise a lot in a short period of time. So the stock market has historically gained more than 20% in nearly 4 of 10 years. So in general, covered call funds make less than the stock market because they miss the large gains, which happen relatively often. So they're generally seen as somewhat more conservative, lower return investments that give you a regular income. Now, in general, they have higher tax because the premium is taxable. Now, it may be taxed as capital gains or income, and that depends on some details of the fund. So now, if the cash you received is a fixed amount, it probably will include some return of capital in addition to the premium taxable income. Okay, now why are monthly pay ETFs or funds a problem for retirement income? So for retirement, you need cash flow that rises with inflation so you can maintain your lifestyle. So fixed monthly pay ETFs or funds pay the same amount all the way through. So, seniors often complain about being on a, fixed income. This is what fixed pay funds provide. Now, there's two types of fixed pay funds. There's the ones that pay the same dollar amount, so it's a fixed dollar amount, and then there's the ones that pay the same percentage of your investment. So now the same dollar amount is a fixed income regardless of the return on the investment. It doesn't rise with the cost of living, and it may or may not be sustainable. So there was a classic story, like nearly 20 years ago, there were some income funds with a fixed dollar distribution that was about 12% originally of the investment. So they were essentially balanced funds, so highly unlikely to make 12% a year long term. So you can kind of see these are kind of destined to fall apart. Now, in 2008, they lost 30% while paying out this 12%. So the investment value dropped over 40%. So the fixed dollar distribution was then 21% of the fund, up from 12. So of course the fund kept dropping in value and would never recover. The distribution had to be stopped. So it just wasn't sustainable. So that's one potential issue there. Now, the same percentage is like mutual fund T8 funds. Okay, so this is a fixed pay with the same percentage. They pay a monthly distribution of 8% of the December 31st balance for the next year. Okay, now the next year, the distribution is adjusted to 8% of the year-end balance. So your cash flow goes up and down every year based on the rate of return of the prior year. You would have to adjust to a different retirement cash flow every year, and it probably won't rise with inflation. Now, why are monthly pay ETFs and funds a problem for leverage investors? Okay, with borrowing to invest into fixed pay ETFs or mutual funds, your investment loan probably does not remain fully tax deductible. Now, some people may think, "Oh, this is cool. I'm gonna borrow at 5 or 6%, but I can buy something that pays me 10% cash flow." However, there's a problem with it. So the monthly payments usually include some return of capital. Okay, and remember, the 10% you're getting isn't your rate of return. That's just the cash you get. So this happens if the return of capital happens if the distribution is more than the income. So the return of capital reduces the amount of your investment loan that's tax deductible. You have to track this. It's up to you. So this is called the Smith-Snyder calculation. So if CRA audits you, your borrowing to invest strategy, it's up to you to support your interest deduction. CRA does not correct your number. They either approve it or deny it. So if you can't support your number, they just deny the whole thing. So you've got to be able to track this if you get it. That's why these are often kind of a problem for leverage investors. Now, how do we get out of the brain fart? Basically, you should focus on the investment value plus the cash you receive. For example, without a distribution, you have an investment that's worth $100,000. Now, if that investment has a fixed monthly distribution that's $8,000 over the year, then your investment value would be $92,000, and you have $8,000 cash. You still have $100,000 in there. Okay, plus of course it goes up and down, but basically you've got the same $100,000 if you add those two together. And if you think of those dollar amounts, then you don't get caught in this brain fart of, oh, how much cash? Oh, the cash I'm getting is income, but it's not actually income. How could you perfect monthly pay ETFs or funds? The answer is what we call self-made distributions. I've talked about this before, or self-made dividends. Basically, you keep all the advantages and you avoid all the disadvantages. So what are self-made dividends? So simply, you sell a bit of your investments each month, or can be each month or whenever you want. You choose the amount. Can be automatic with some investments, such as mutual funds, or like we work with some independent portfolio managers. They can make it automated. Only withdraw when you need cash. It's very tax efficient, and you got to remember, you need cash flow, not income. So income is taxable cash flow, and that's what this self-made dividends provide. So now, effective investing for income, here's how you do it. Number one, invest in equities based on maximum long-term rate of return. So equities are actually, they show you over long periods of time, they are the most reliable, not income-based investments. So, and then you just ignore all the distributions, you just reinvest them all. So you've just got the investment that is growing. Then you start taking self-made dividends only when you need cash flow. Okay, so you need cash flow and income. Income is your taxable cash flow. Now, when you're saving for retirement, that's your accumulation phase, you choose self-made distributions or self-made dividends of zero. Okay, zero cash flow needed for your investments, and this avoids tax on any cash flow that you receive. Okay, and now when you start to retire, you start your self-made dividends for a sustainable withdrawal amount to provide the retirement you want. So this is the decumulation. Probably invest the same as the accumulation phase. You or your spouse probably have 30 or more years left, either one of you. It's long-term. The 4% rule has historically worked with investments between 70 and 100% of equities. And the 2.5% rule works for a bond investor. So instead of the 4% rule, so you take a sustainable amount. Okay. So that's how you do it. Self-made dividends are a perfect fit for your life. Now, self-made dividends are better than monthly fixed pay ETFs and funds in every way. So first of all, you can get better returns because you can invest for risk, return and risk, not for income. So you get the cash flow you want while investing for the maximum reliable long-term growth. So, and number two, you control the timing, frequency, and the amount of the cash flow. So you're in complete control. It's just told you have to take this monthly amount. So you sell the actual amount you need when you need it instead of having to receive a large monthly amount. So they're generally lower tax because only like if you sell a bit of it, you pay a bit of a capital gain on that. Okay, but you don't have to have the entire investment amount invested for income. All the rest of it can be invested very tax efficiently for growth. So also you defer tax until you sell. So deferred capital gains are the lowest taxed type of investment income. And so most of the portfolio then can be invested for deferred capital gains. And it stays there until you need the money. You can also diversify globally. It doesn't have to be Canadian. The cash flow, you only get cash flow when you need it. So you're not forced to pay tax when you don't need the cash flow. So no cash when you don't need any. So another big advantage. And you can plan for your cash flow to rise by inflation every year. It's the perfect fit for a long-term cash flow to maintain your lifestyle. Yeah. All right, that's my talk today. So monthly fixed pay ETFs and funds are a brain fart. I think you see it now. What we talked about are why are monthly pay ETFs and funds a brain fart? How do fixed monthly pay ETFs or funds work? Why is a monthly distribution not part of your rate of return? What's the difference between a distribution and a dividend? Why is a monthly distribution not new money? Why does a monthly distribution equal selling shares? Why does a reinvested distribution equal no distribution? Why do covered call funds usually have lower returns but higher tax? Why are monthly pay ETFs or funds a problem for retirement income? And why are monthly pay ETFs and funds a problem for leverage investors? So, how can we get out of this brain fart? How can you perfect monthly pay funds? What are self-made dividends? And why are self-made dividends a perfect fit for your life? All right, so my name is Ed Rempel. My blog is called Unconventional Wisdom. It's the #1 blog in Canada for a full-service financial planner. It's just unconventionalwisdom.ca, but remember, you got to do .ca if it's unconventional wisdom. We offer a free 30-minute consultation if you're potentially interested in talking with us or working with us. Just go to Google, go to edrempel.com/talk. You can also subscribe to my blog, podcast, and YouTube. However you want to, if you want to watch, hear, or read. And if you subscribe to it, all that happens is you get my new talks, every week or whenever they come out directly to your email. The podcast is edrempel.com/listen, and YouTube is edrempel.com/watch. Thanks for listening, and we'll talk to you next week.